Imagine waking up one morning and discovering that half the money in your bank account has vanished. Not because of a hack, not because of fraud, but because the government quietly printed trillions of new dollars overnight. You didn't vote for it. You weren't warned. Yet your savings are now worth far less than they were yesterday. This isn't science fiction. It's not a conspiracy theory. It's the hidden reality of inflation. And it's been happening for centuries. In fact, inflation is the oldest trick in the government's playbook for stealing from its own people, without ever having to raise taxes. Today, we're going to uncover the secret history of inflation, how it began, how it evolved, and how modern governments perfected it into a silent, invisible tax that drains your wealth every single day. But before we dive in, where are you watching from? Please tell me in the comments. I read every single one, and it helps me know who I'm speaking to across the world. Inflation isn't just prices going up. That's the symptom, not the disease. The real cause is far more deliberate. At its core, inflation happens when the supply of money grows faster than the supply of goods and services. When there's more money chasing the same amount of stuff, prices rise. But here's the twist. Governments don't accidentally print too much money. They do it on purpose, often to pay for wars, bail out banks, fund massive spending programs, or avoid the political fallout of raising taxes. Raising taxes is unpopular. Voters notice. Politicians lose elections. But inflation is stealthy. It creeps in slowly, disguised as cost of living increases or market fluctuations. Most people never connect the dots. They blame greedy corporations, supply chain issues, or bad luck. Never the central bank quietly doubling the money supply behind closed doors. And that's exactly how those in power want it. To understand how we got here, we need to go back, way back. The story of inflation begins not in the 20th century, but in ancient Rome. Around 200 AD, the Roman Empire was running out of silver to mint coins. Wars were expensive, and the treasury was empty. Instead of raising taxes, which could spark rebellion, emperors like Nero and later Diocletian came up with a clever solution. They kept the coins the same size and appearance, but gradually reduced the amount of silver inside, replacing it with cheaper metals like copper or lead. To the average citizen, a denarius still looked like a denarius, but its real value was shrinking. Prices began to soar. Soldiers demanded higher pay. Merchants raised prices daily. The economy destabilized. Historians now believe this monetary debasement was one of the key factors that contributed to the fall of the Western Roman Empire. The lesson? When you erode trust in money, you erode trust in the entire system. Fast forward to the 16th century. Spain had just plundered vast amounts of gold and silver from the Americas. Suddenly, the Spanish Empire was flooded with precious metal. Sounds great, right? But all that new money didn't create more bread, more cloth, or more houses. It just meant more money chasing the same goods. Prices in Spain skyrocketed, by some estimates, over 400% in a single century. This period, known as the Price Revolution, was one of the first documented cases of large-scale inflation caused by an influx of money. And once again, ordinary people suffered while the elite, those closest to the crown and the mines, profited first. The pattern was becoming clear. Whoever gets access to new money first gains immense advantage. Everyone else pays the price later, in the form of higher costs and diminished purchasing power. But the real turning point came in the 20th century. During World War I, governments needed unprecedented sums to fund tanks, planes, and armies. Raising taxes alone wasn't enough, and too politically risky. So countries like Germany, Britain, and the US turned to their central banks to print money. After the war, many tried to return to the gold standard, but the damage was done. Then came the Great Depression. In response, governments abandoned gold altogether. In 1933, President Franklin D. Roosevelt outlawed private ownership of gold in the United States. Citizens were forced to turn in their gold coins for paper dollars, at a fixed rate. Shortly after, the government devalued the dollar by 40% overnight. That meant your savings just lost 40% of their international value. Again, no vote, no warning, just a quiet transfer of wealth from the people to the state. But nothing illustrates the destructive power of inflation more vividly than Weimar Germany in the early 1920s. After losing World War I, Germany was forced to pay massive reparations. Unable to raise enough through taxes, the German government simply printed more and more marks. At first, prices rose slowly, then weekly, then daily. By 1923, hyperinflation had reached absurd levels. Workers were paid twice a day and rushed to spend their wages before lunchtime because by afternoon, the money would be worth half as much. People used wheelbarrows full of cash to buy a loaf of bread. Children played with stacks of billion-mark notes as toys. Savings were wiped out overnight. Pensions became worthless. The middle class was destroyed. And out of that economic chaos rose extremist movements, including the Nazi Party, which promised stability and order. Inflation didn't just steal money. It stole hope, trust, and democracy itself. So how does this apply to today? In 2008, during the global financial crisis, central banks around the world, led by the U.S. Federal Reserve, launched a policy called quantitative easing. In simple terms, they created trillions of dollars out of thin air and used it to buy government bonds and mortgage-backed securities. The goal was to stabilize the financial system. But the side effect? A massive expansion of the money supply. Then came 2020, the pandemic hit. Governments spent like never before. The U.S. alone added over $5 trillion in new debt in 2 years. The Fed's balance sheet ballooned from $4 trillion to nearly $9 trillion. And what happened next? By 2021 and 2022, inflation surged to 40-year highs. Groceries, gas, rent, all skyrocketed. Wages couldn't keep up. And once again, average people felt the pinch, while asset owners, those who held stocks, real estate, or Bitcoin, saw their wealth grow thanks to the flood of cheap money. This is the modern version of the old Roman trick. Instead of clipping coins, governments now create digital money with a few keystrokes. Instead of wheelbarrows of cash, we have rising grocery bills and shrinking paychecks. The method has changed, but the motive remains the same: to finance government spending without the political cost of taxation. Economists even have a name for it: seigniorage, the profit governments make by issuing currency. In essence, every time a central bank prints a dollar, it costs them almost nothing to produce, but that dollar can buy real goods and services. That difference, the hidden profit, is extracted from you, the holder of money, through the slow erosion of its value. Over time, this acts like a tax on savings, on wages, on anyone who relies on fixed income. And because it's not labeled as a tax, it's rarely debated in elections or town halls. But here's the most insidious part. Inflation doesn't affect everyone equally. It's a regressive tax that hits the poor and middle class hardest. Wealthy individuals don't keep their money in savings accounts. They own assets, real estate, stocks, businesses, that tend to rise in value when inflation increases. They also have access to financial advisors, hedge funds, and tools like Treasury inflation-protected securities, TIPS, to protect themselves. But the average worker, they're stuck. Their salary lags behind prices. Their emergency fund loses value every month. Their retirement account, unless carefully managed, gets silently diluted. In this way, inflation doesn't just steal money, it widens inequality. It transfers wealth from the many to the few, all under the guise of monetary policy. Now, you might be thinking, if this is so obvious, why doesn't anyone stop it? The answer lies in incentives. Politicians benefit from short-term economic boosts created by money printing. Voters see low unemployment and rising stock markets, at least temporarily, and give credit to the current administration. Central bankers, though technically independent, face immense pressure to support the economy during downturns. And the media often frames inflation as a mysterious force beyond anyone's control, never as a direct consequence of policy choices. Meanwhile, the long-term costs, eroded savings, distorted markets, loss of monetary trust, are diffuse, delayed, and hard to pin on any one person. So the cycle continues. Yet history shows us that currencies don't last forever. The British pound has lost over 99% of its value since 1913. The US dollar has lost over 96% of its purchasing power since the Federal Reserve was created in 1913. Every fiat currency in human history has eventually collapsed, either through hyperinflation, devaluation, or replacement. None have survived in their original form for more than a few centuries. That doesn't mean the dollar will collapse tomorrow. But it does mean that relying solely on government-issued money as a store of value is a risky bet over the long term. Smart individuals throughout history have protected themselves by holding real assets, land, gold, art, or, in the modern era, decentralized digital assets like Bitcoin that can't be printed at will. Which brings us to a crucial question. What can you do about it? First, understand that your biggest enemy isn't at high prices. It is holding too much cash for too long. In a world of persistent inflation, cash is a depreciating asset. Second, educate yourself about alternative stores of value. You don't have to go all in on crypto or gold, but diversifying even a small portion of your savings can provide a hedge. Third, focus on skills and income streams that can adjust with inflation, like owning a business, having in-demand expertise, or investing in assets that generate real cash flow. Knowledge is your best defense, because once you see inflation for what it truly is, not an accident, but a policy, you can no longer be fooled by the illusion of normal prices. If you've made it this far and you're finding this video eye-opening, please do me a huge favor. Hit that subscribe button and turn on notifications. This channel is dedicated to uncovering the hidden systems that shape our world: money, power, history, and freedom. And I can't do it without your support. Subscribing helps YouTube show this content to more people who need to hear it. Plus, I've got much more coming on topics like central banking, the future of money, and how to protect your wealth in uncertain times. Let's not forget, inflation isn't inevitable. It's a choice. And once enough people understand how it works and who benefits from it, we can demand better. Transparent monetary policy, sound money, accountability. These aren't radical ideas. They're the foundation of a free and fair economy. So the next time you see headlines about rising prices, don't just sigh and accept it. Ask, who created this money? Who got it first? And who's really paying the price? Because the secret history of inflation isn't just about the past. It's happening right now, in your wallet, your bank account, and your future. And now, you're no longer in the dark. Thank you so much for watching. If you learned something new today, please drop a comment below. Tell me where you're watching from and what part of this history shocked you the most. Your comments inspire the next videos. Until next time, stay curious, stay informed, and never stop questioning the system.